SA listed property has been the beneficiary of some strong price performance over the past 2 months. Looking at the SAPI index, we can see that to the end of November, we're up over 15%. This as the market starts to acknowledge the significant value that the sector is offering. If you're of the opinion that you've missed this initial bounce, looking a bit further out, we can see that despite the strong movement, there's still a long way to go, and the market is not acknowledging the underlying value or the underlying fundamentals of the sector as a whole. So looking at these in a bit more detail, we can see that the dividend yields remain very high at high single and low double-digit levels. Our discounts relative to underlying net asset values remain large, between 30 to 40%, and loan to values continue to decline from the 40% level. Looking at the most recent results that we've seen from the sector, we can see that net property income growth has turned positive. As well, on top of that, we're seeing that most of the SA listed property names are anticipating low single-digit increases to continue over the next 12 months. Vacancies continue to decline across the board and across the various different sectoral exposures. In addition, distributable income per share is showing single-digit increases. And following on from this, the payout ratios are pushing past the minimum requirement of 75%. This does give us a lot of comfort as it shows the SA property guys are quite happy to be in their cash flow levels to be paying out more than what regulatory requirements expect from them. As mentioned, dividends have returned, and we're sitting at nice high levels. Net asset values have proved to be fair throughout 2020, and what we've seen is that sales that have gone through in the market have taken place at or close to underlying net asset values. These NAVs continue to grow from those levels. The goal and the focus of management teams coming out of the pandemic, which was balance sheet bolstering and making sure everything was secure going forward, has started to bear some fruit, and we can see that loan to values continue to decline from the levels seen in 2020. Looking at the underlying sectors, retail, which is one of the biggest contributors, is starting to show signs of recovery. We're seeing demand for space increasing significantly, and this has been highlighted not only by the SA property companies, but also by the big retailers. In addition, they have announced that, or they have mentioned that negotiations have remained pretty tough, but despite this, the property sector have said that they remain cautiously optimistic on this particular sector. Industrial continues to show a lot of strength, and at the moment it's starting to indicate an environment that is normalizing. Office still struggles with an oversupply, and although negative reversions remain, these are improving from current levels. And in addition to that, the property guys have announced that demand is starting to resurface. Just to calculate a basic potential total return from here, if you take the current dividend yield of around 10% on average, you add in some dividend growth from here, which at the moment is being forecast at around 5%. You add in some potential capital upsides, so let's say 15% from here, bearing in mind that the market is pricing in a 30 to 40% discount relative to underlying. It gives you a potential total return of 30% from current levels.